And our next guest believes that stocks can continue to rise. Joining us now is Chris Hyzy. He is Merrill and Bank of America Private Bank CIO. Chris, what is this, a technical rally? We broke through 4,200, 4,300, new money coming in, technicals. Is it the Fed's done? Is it inflation looks a little more under control? Is it D, all the above? What's going on?
Now, one of the moves this go around, actually, if you look at it from the start of the year, is positioning, as you know, Brian, was so poor. Positioning was way offside. There were a lot of hedges in place, very defensive, competing curve with 5% cash rates. Money was just parked there. And then once the market starts to see that this story is unfolding, whether some believe it's a soft landing, others will point to inflation coming down, actually a little bit more than what was originally discussed or expected. And then you all of a sudden get a Fed pause or a skip or maybe a couple of skips. And lo and behold, you get another story in the innovation sector called technology, and that is generative AI. And those tailwinds all hit at once, and that's what creates a momentum market. So technically speaking, very good. And there was a lot of concern about the narrow breadth of the market, but we've done a lot of studies that suggest that narrow breadth doesn't mean a bear or bull market. It's happened in many different cycles. So we're quite happy. We applaud this. We're going to continue to be balanced, and we're going to look actually for the next week periods.
And you go back to those stats, Chris, and I can't remember the exact ones, but you get directionally correct. How about this, which is the bulk of the money long-term investors make in stocks comes on just a few days a year, does it not? It's sort of the argument for not trying to time it, being invested, because you get these 1 and 2 week bursts, and then maybe you do nothing for 6 months, but that's where you make your money.
Yeah, that's a great point, Brian. You know, we all talk about diversification, asset allocation, but few people, when it comes down to thinking about the long term, believe what you just said, which is you can get caught off sides very quickly. And it's not necessarily market timing that is needed, it's time in the market. If you miss the best few days of each year or each decade, going all the way back to the 30s, you've missed a good portion, if not almost all, of the big gains over those decades of periods. So we're not just going to set it and leave it and create an asset allocation to match long-term objectives. We're going to look for opportunities. And when cash flow comes in and there's weak periods in the market, that's when you rebalance. That's when you use dollar cost averaging and you use time in the market to your advantage.
Where are said opportunities?
Well, certainly you can't be offsides in technology, so at least being neutral there. But one caveat, obviously, is the fact of the big run, not only in semiconductors, but in some of the areas that the story is yet to be told. In some cases is being told, but around generative AI. So you have to be careful there because many of those companies have already priced in years worth of earnings, if not cash flow. But the tailwinds to productivity coming from things like AI in the industrial space, if you consider what's going to be needed with the power grid, what's going to be needed with electrical equipment to cool down and cooling systems to cool down some of these data centers, not to mention some of the beneficiaries of the Inflation Reduction Act, and dare we say energy. Energy has had a very difficult time, particularly heading into a slowdown in the economy. But as we come out and we bottom out in the economy over the next, say, 6 to 12 months, energy should start to reignite itself once again. And that's a sector you know very well.